Hey, what's up you guys? Swan here from Swan Things. So it's been a while since my last video because I've been really focused on my day job and side hustle for the past couple of weeks. It is super exhausting and adulting is hard, which is why it's so important to start investing and generating passive income. Because at some point, all this hustling can really wear you down. So in this video, let's go back to basics and look at all the different investments and financial products out there that you could use to grow your wealth and generate some passive income, all explained in 1 minute or less. I hope to give you a basic pros and cons of each of these investments so that you better understand your choices. So without further ado, let's begin. First, let's look at retirement funds. And in Malaysia, there are two types, the EPF and PRS. These funds are illiquid, which means that your funds are locked away and withdrawal is restricted for long-term investment. The EPF is an excellent investment because it offers capital guarantee with no risk of loss and inflation protection of at least 2.5% guaranteed by the government. On top of that, the money you put in the EPF is managed for free, and historical returns have been pretty good at around 6% in the past decade. The PRS, on the other hand, is far less attractive. Because these are privately managed funds, they come with high fees and no capital guarantee, which means that you might lose some of your money. PRS contributions are optional. However, I still recommend you invest 3,000 ringgit a year because you will receive a tax deduction for doing so. Next, let's look at some low-risk products. And the Malaysian favorite is fixed deposits, where you agree to store a certain amount of money in a bank for a certain period of time, and at the end of the period, you get all your money back plus a little bit of interest. Although there is no chance for you to lose any of your money with fixed deposits, the returns are horrendously low, which means that it is better suited to safeguard your emergency fund and not as a tool to build your wealth. An alternative to fixed deposits are money market funds like Stashaway Simple and Versa. With money market funds, your money is pooled together into a large fund and lent to banks, and in return, you get a little bit of interest. Unlike fixed deposits, money market funds are more liquid, which means that you are able to withdraw your funds at any given time without any penalties on the interest generated. Another low-risk investment that is unique to Malaysia are fixed price funds offered by Amanah Saham Malaysia. There are two types of funds, the ASB, which is only open to Bumi Putra investors, and the ASM, which is open to all Malaysians, but with specific quotas for each race. These fixed price funds offer decent to high returns, but since the price of the funds are fixed, there is virtually no risk of you losing any of your money. A risk-free investment with dependable returns is essentially the holy grail of investments, which is why these funds are so popular, difficult to buy, and come with purchase limits. If you want to try your luck, you can try to purchase these funds over the counter at any ASMB branch. Alternatively, you can queue for these funds online. Good luck because you'll need it. When a government or business wants to borrow a large sum of money, they can choose to issue bonds. Investors who buy the bonds agree to lend out their money in exchange for a bit of interest. The bonds issued contain details like how much money you will lend out, how long it takes to be repaid, the amount of interest payable, and the dates of repayment. Obviously, you can profit from bonds off of its interest payments, but you can also choose to sell these bonds to someone else, hopefully at a higher price. The price of these bonds fluctuate according to supply and demand. However, the interest payments stay the same, which is why it's called a fixed income instrument. Because the interest payments stay the same, but the price of the bond fluctuates, the bond yield or your profit rate will depend on the price at which you buy these bonds. Real estate has long been a favorite investment, and it's pretty easy to see why. Real estate prices have generally gone up over time, and you can also choose to rent out these properties to generate passive income. The best part is you don't even have to pay the full price of the property to enjoy its profits. All you have to do is take out a low interest rate mortgage, heck, take out a few, and enjoy multiple streams of passive income from multiple properties. However, times have changed, and real estate prices have remained relatively flat, with rental yields dropping to about 2 to 5% a year for the past few years. This, along with many other disadvantages, makes real estate a risky investment. To counter this risk, consider buying a REIT, which is a stock that allows you to own and profit from a large portfolio of different properties, all managed by professionals. Stocks are one of the most popular investments out there. When you buy a stock, you essentially own a small percentage of a company's assets and are entitled to a small portion of its future profits. When a company does well, they can choose to reinvest the profit back into the business to grow it. In this case, stock prices generally go up and you can sell off your stock for a profit or capital gains. Some companies may choose to pay out part of their profits back to investors as dividends, giving you passive cash flow. Stocks are considered high risk because the prices are constantly changing, influenced by factors including company performance, business competition, economic environment, future prospects, and worst of all, the psychology and sentiment of emotional and irrational investors. If you don't have the confidence to pick your own stocks, you can choose to invest in unit trusts. By doing so, you are trusting a fund manager to do your investments for you. The great thing about unit trusts is that you don't really have to do anything other than pick a fund and schedule your deposits. However, the downside is that these unit trusts charge an exorbitant amount of fees that compound over time, which will eat into your profits. On top of that, most unit trusts don't do well in the long term. In fact, less than 3% of unit trusts in Malaysia are able to beat the ASB, and less than 7% are able to beat the EPF after fees in the past 10 years. A good alternative to unit trusts are exchange traded funds or ETFs. ETFs are basically stocks that own a large number of companies. For example, you could own a small portion of the 500 biggest companies in the US by simply buying an S&P 500 ETF like SPY or VOO. The advantage of ETFs is that it lowers your risk through diversification, has much lower fees compared to unit trusts, and index tracking ETFs have generally had a long history of good performance. You can buy ETFs directly on local or overseas brokerages. But if you're lazy, robo-advisors like Stashaway and Wahid Invest will automate your investments into a basket of different ETFs. All you have to do is pick a risk level you're comfortable with, schedule your deposits, and watch your money grow over time. If you're looking to take more risk, you can choose to invest in derivatives. Derivatives are contracts that have its value tied to the future value of an asset. When you buy a derivative, you don't actually own the asset. What you own is sort of like a voucher that gives you the choice to buy or sell a certain asset at a fixed price at a date in the future. For example, a company warrant is a derivative that gives you the right to buy or sell a company's share at a fixed price in the future. In order to profit from derivatives, you need to correctly predict the future value of an asset. The advantage of derivatives is that it can amplify your gains through leverage, and you can also profit in both directions of price movement. However, it's a complex investment best suited for advanced investors because it can also amplify your losses and are highly volatile. Commodities like precious metals have been around since the beginning of trade. These metals are the OG of store of values, thanks to its limited supply, unlimited shelf life, and a strange human attachment to shiny things. Gold is the most popular. used as an inflation hedge and a safe store of value in times of economic, political, and financial crisis. Silver and platinum, on the other hand, is valued additionally by their industrial use in electronic and automotive industries, and so the prices fluctuate more than gold. Investors hold precious metals to diversify their risk and lower volatility, because the prices of these precious metals are relatively stable and tend to move up in times of crisis. However, the downside is lower growth potential, as can be seen in their historical performance. A recent contender to precious metals are cryptocurrencies. Cryptocurrencies run on blockchain technology, which enables decentralized currencies and applications that cannot be manipulated or controlled by any one party. Bitcoin is by far the most popular, used as an inflation hedge and store of value. Recent mainstream adoption by companies like Tesla, Visa, and Square, along with rising risks of inflation thanks to widespread money printing, have really propelled the demand and price of Bitcoin, with some touting it as digital gold. But Bitcoin is only one of the many cryptocurrencies out there with promising futures. Ethereum, for example, offers programmable blockchain applications and smart contracts, giving rise to products such as DeFi, NFTs, DAOs, and more. The possibilities are endless. And that's all I have for you today. There are plenty of other investments out there, but these are some of the popular ones that you should consider. Having a good mix of some of these investments is a great way to diversify your risk and grow your wealth. And I hope by covering some of the basic pros and cons of each, you are able to make a more informed decision on where to invest your money. As always, thank you so much for watching. Smash that like button and subscribe to my channel if you haven't already. It helps me out a great deal, and hopefully I'll see you in the next video. Bye!